welcome everybody. It's your boy Coach Angel here with FIRELife Financial. Today we're going to talk about several things. We're going to be talking about what we're all about, some of the stuff that we teach our clients, how to manage debt, the debt through different concepts like the Debt Snowball. I don't know if you're familiar with Dave Ramsey and Financial Peace. So we've helped clients that way. That's one of the personal things that I've used. We're also recently been teaching our clients about velocity banking, speed banking, and now we're getting into teaching the infinite banking concept, leveraging whole life dividend paying life insurance to help you build cash flow, cash value that then you can use to finance your expenses, things that you normally would go to a bank for, to a particular lender for. You can now become your own bank and begin to build and capitalize on that interest and building up of cash value. And so there's a whole philosophy around that. If you're not familiar with Becoming Your Own Bank by Nelson Nash, I highly recommend that you check that out. And there's definitely other people out there that are teaching some of these concepts. Denzel Rodriguez, want to give you mad props. Really been very influential with me on the velocity banking concepts and stuff like that, which I had heard in the past, and I had studied and researched it about how to pay off your mortgage really fast, but I did not think to apply it to your personal expenses, specifically for debt. And so there's different ways that we can help people with their debt, so you can try to maximize your cash flow, get rid of all those extra expenses, all that money that you're paying to banks and credit cards and everything else. That money comes back to you, and you can use that to start building wealth. And combine that with infinite banking and the infinite banking concept, you can start to build up a cash value in a policy that then you can use through policy loans to finance your expenses or investments or different things. So it's a very interesting stuff. Some of the stuff we've been teaching our clients and the stuff that I've been practicing personally in my personal life. So this is how we're able to help people. And so we offer various things, and we're going to get into some of that a little bit later. But I wanted to take a case study and start with the basics first and foremost, which is budgeting. That is the foundation for everything. Everything else works when you know how to manage a budget. If you cannot manage a budget, if you're not disciplined enough, and that's the key word, discipline. If you're not disciplined enough to manage your household budget, there is no way you're going to be able to maximize and leverage the infinite banking concept or even velocity banking. Okay, so it has to start there, because let's face it, if you cannot have self-control in your spending and you're spending every dollar that's coming in, I can't help you, because you're not ready. You're not at the point where, you know what, I've had it. You have to get to that point where it's your I've had it moment. You know, I'm sick and tired of being sick and tired. We make way too much money to just see it all go to someone else. So until you've gotten to that point, I probably cannot help you. But if you are at that point and you're fed up with debt, then we can get started. But it has to start with a budget. And I know right now, some of you, your eyes just glossed over the back of your head. You just rolled your eyes at me. We know, but just smack yourself on the back of the head, right? Get your eyes back forward, because if you can win with a budget, then you can win with your finances, and the world becomes your oyster. So there's a lot of opportunity if you can be disciplined enough, focused enough to start with a budget and get your stuff straight. So I'm going to start with a real world scenario, and I've rounded off the numbers so that so it makes it much easier, but you know, any numbers work, okay? Any numbers work. And these concepts will work for anybody, okay? They can work with any budget, they can work with any scenario, but they're not for everyone, okay? Because some people like to keep things very, very simple. I mean, this is very simple, and you know what? The Debt Snowball is very simple for most people. You can, if you're maybe younger or you like things fast paced, boom, 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 you know what? Velocity banking might be something that can help you and you can leverage it. And you know what? You'll pay off debt a little bit faster It's not some magic 8 ball. It doesn't happen overnight. It's not some get rich quick scheme or anything like that. So depending on your specific scenario, and more importantly, your personality and what you're able to cope with, the risk that you're willing to take, because you can do it through the debt snowball and just totally eliminate debt as fast as possible, okay? Or you can learn to leverage debt, right, through a line of credit and things like that, or even potentially a credit card, which I don't recommend, but people can do it. It is possible. But you can leverage these different tools, these debt tools, to help pay down your debt. But you have to have cash flow, which means you have to be on a budget and you have to be disciplined. Because without cash flow, this doesn't work. If you're spending all your money that's coming in, then it's not going to work. You're going to either have to increase your income or cut down your expenses, one or the other, or a combination of both, because you have to have cash flow in order for these systems to work. Okay, and later on in other videos, we're going to get further into the the infinite banking concept, because that's when things get really strategic, and for long-term investments and purchases and things like that, it becomes really enticing. And you start to see what's possible when you learn to take control of your own finances and you start to build a family bank. Okay, so we're going to get into a lot of those things. So if you don't know me, my name is Angel Abundis. People call me Coach Angel. Okay, and I'm with FIRELife Financial. And I'm going to help you to leverage some of these concepts and some of these principles so that you can get control of your finances. And wherever you are in the country, I can help you. Okay. Now, I won't be able to help you to implement an infinite banking policy. Okay. But I have other people around the country that can help you. But if you're in California, in the West Coast, Western states, Nevada, Colorado, Texas, things like that, I will be able to help you with those things. But more importantly, the financial coaching of it and breaking down your numbers and helping you set up a plan for you to succeed, that's something that I can help you with. And so we have clients around the country already. We're starting to build up our client base. So I'm really excited that we're going to be helping a lot more people. And the way we're going to do that is through social media and things like that, so we can get our message out there. And we want people to win with money, because let's face it, America's in a real problem right now. We are saddled with so much debt, and the government is printing money like crazy, just making it rain. And all we're doing, it's just the way people do it with their own lives. They're just putting it on credit, and eventually that bill's going to come due. And it may not happen in my generation, but our children and our children's children, they're going to pay for the stupid mistakes that our country's doing right now. And so you better put yourself in a position, and more importantly, put your family and your generations and your generations upon generations in a much better situation. And if you learn to leverage the infinite banking concept, okay, then you can become your own bank. You can separate yourself and insulate yourself from the system of the world and the way that they're using money and leveraging money. Because all of that interest and all those loans that you're getting, the car loans, the mortgages, credit cards, all that stuff, you're making somebody else money. They're the reason why they're sitting like fat cats in those big buildings that has their name on them, and you're in your home in an apartment barely getting by. And you have a fat car payment, and you have a big credit card, and you have a mortgage or a HELOC or whatever else, and you are the one that's in debt, and you're making people rich with your work. You work, you make money, and yet you go and you pay somebody else to manage your money. You put your money in somebody else's bank. You put your interest in somebody else's account, and they're getting paid dividends, right? And their stocks are going up and all this other stuff. So don't even get me started. There's a lot of problems that we need to deal with, but we have to start at home. It has to start in your life, in your heart first. And so we're going to get into that. So let's start first with a budget. And again, if your eyes just glossed over, just smack yourself in the back of the head, roll those eyes forward, and let's just break down some of the numbers. So we're going to get into budgeting, okay? And this is pretty much a real world scenario from one of my clients. Again, I reduced some of the numbers. I rounded things off just for simplicity's sake, but just to keep it keep the math really easy. Again, but this could work with anyone. Okay, in any situation, any budgeting, you got to do it no matter how much you make. Whether you're making $1 million, you're making $100, budgeting is the key, because that's what's going to help you understand and know your numbers. You have to know your numbers. You have to know how much money's coming in, how much expenses are going out, and ultimately what you want to get to is your cash flow. How much cash, extra cash, disposable income do you have to work with? Because that's what's going to dictate how much freedom you have and how much you're able to do with other things that you want to do for your future. Okay, so we're going to get into some of that stuff, because we should be thinking long term. If all we're living for is today and just focus on today, you're not going to be prepared for things that happen down the line. A wise man plans. Okay, that's what you have to be focused on. Right? You want to leave a good inheritance for your family, for your kids, for your grandkids, your kids. Right? Now, if you don't have no kids and you're young and you're single, you should still be budgeting, because you should be thinking about how you can stop working eventually, right? And that's what the FIRELife Financial is all about, right? The FIRE movement, financially independent to retire early. So if you really want to get to freedom and become financially independent, you have to try to get there as fast as you can, and you have to try to maximize your cash flow. Maximizing your cash flow is going to give you a lot of options, and that's what being financially independent is all about, is having freedom to make options and have opportunities. Because if you're just focused on the right now and living for today, and you're spending all your money, okay, you're going to be stuck in that dead-end job for as long as you possibly can work, and you're not going to be thinking about all the amazing things that you could be doing. So that's just something that we want to be focused on, financial independence and having that true freedom. And that's what the American dream is all about, people. That's what I want to help all the people that I talk to, all my family, all my friends, all my clients. I want them to be thinking about that. What does the American dream mean for you? Is it maybe buying a vacation home, right, in the mountains, Vail, Colorado or something, Big Bear, right? Or maybe having a vacation home in some other country, around the beach, right? Maybe down in Mexico or something, or in Costa Rica, right? Or Puerto Rico, or whatever it is, right? Maybe it's in the Philippines, or maybe it's somewhere in some island chain or something like that. Wouldn't that be amazing? If you can travel there whenever you want, and you have your own home, it's paid for, and you're renting it out occasionally, possibly, right, as a vacation rental, and you're making this, right, passive income coming in, but you can also go down there and enjoy it whenever you want. You can take vacation whenever you want, and hopefully you're making passive income in many different areas that you're still making money while you're vacationing on the beach. Those are some of my goals. That's what I'm getting to. That's what we're working towards, and we'll be sharing some of that on this channel, sharing our journey with you. Anyways, I digress. So let's get to the board. So here's a real world scenario. One of my clients, their income is actually a little bit higher, just a couple $100 higher, but I rounded it off to $10,000. Their expenses, $8,400. Okay. Now, in their budgeting, we've kind of set things up. They're Christian people. It's all about spreading the kingdom and making sure that they're doing things right. Now, this is their take-home pay. So their actual gross pay is actually higher. But, you have taxes, insurance, and all that other stuff. Okay, they are putting some money in 401k. We're not even going to touch on that, because you should be putting some money in 401k. And we tell people you should be paying yourself first, right? So that's definitely something as we get into this, right? I'm going to write this down. Pay yourself first. It's an amazing concept that a lot of people forget to do. If you read books like Rich Dad, Poor Dad, and things like that, that's one of the things that he teaches you. It's one of those things that you have to understand. You have to pay yourself first. You have to be thinking long term for yourself so that you have a future. Because if you're focused on, if all you're thinking about it for retirement is living off of Social Security, guess what? I have some bad news for you. Social Security is going to be insolvent in a few years. about 15 years, 2035, the government estimates that they're not going to have enough to meet all their obligations. So you better be thinking strategically to supplement and make sure you have enough to live off of. That's why you should be focused on paying off your mortgage, right? Having no debt, absolutely no debt if possible. That's one of the main things that we teach. But again, depending on your risk, depending on your scenario and what you're able to do, if you're willing to take on a little bit more risk, you want to have a little bit of debt, it's fine. But you have to know how to work it. You have to understand, you have to know what those risks are. So imagine if you had no mortgage payment. I'd say you're living absolutely house free. Maybe you have some insurance and taxes and stuff for your property, but what if you didn't have a mortgage payment? I mean, I live in Southern California. Rents, mortgages are super high. Super, super high. What if you could save that $3,000, $4,000, $5,000 or more, depending on the kind of house you have? What if you had that extra money? What could you be doing with that? Right? That adds up. $3,000 a month in rent or mortgage, that's $36,000 a year. What could you do with that money? So anyways, you want to be thinking about long-term planning. So if you're putting money in 401k, we typically say, and Uncle Dave teaches, Dave Ramsey, right? 15%, minimum 15% you want to be putting towards the future. Typically in a 401k, most millionaires, if you look at the book, Everyday Millionaires, most people use their 401k for building wealth. Now, not everyone, that doesn't work for everyone, and you're riding the market up and down with the stock market. So I am a little more risk averse, so I put a little bit in 401k, but the vast majority of my stuff is now going towards life insurance policy with cash value, a well-structured whole life policy, okay, and also other long-term investments, like Roths and things like that, and also real estate. That's what we're going to be getting into. I want to be focused on that. Anyways, back to here. So, income, $10,000, take-home pay. His expenses about $8,400, right? $8,400 a month, which is kind of a lot. So, their cash flow, which I didn't write this down. All right, we're going to get into that. So, they're Christians. They give about $1,000. All right, now, I am a firm believer that you should be giving. Right, I give off my gross, 10% off my gross. That's just between me and the Lord. Whatever that number is for you, I highly recommend that you learn to give. You be a generous person. It will benefit you in the long run. All right, and that's what the Bible teaches. That's what most people tell you. You want to give. You want to be giving. Not only that, you get the tax deduction, but you shouldn't do it for that. But whatever that number is, whether it's 10%, whether it's 5%, whether it's $5, whatever that number is between you and the Creator, that's between you and Him. But when you give that money, whatever you decide to give, and make sure your spouse is in line with you on whatever that amount is, make sure you do it with a joyful heart, with gratitude because of what you have and what you've been given, and you give that with a cheerful heart. The Bible says that God loves a cheerful giver. And that word cheerful is the word where we get our word hilarious from. You're not just supposed to be like, thank you, God, you're so good to me. Here's a little bit extra for you. And that's what He teaches, right? You give your first fruits, which is why it's at the top. So you should be giving. It's like breathing. It just has to happen. But again, whatever that amount is, it doesn't have to be 10%. We're no longer under the law. We have freedom. Whatever that number is between you and the Lord, just decide in your heart, make sure you agree with it with your spouse, and you guys just give it. And don't give it because you're expecting something back, because you expect, if I give this, I'm going to get 10 times that back. No, none of that. You give it because you want to give it, and you give it without hesitation. Because I'm going to tell you right now, God does not need your money. He doesn't need my money. He just wants your heart. And He wants you to be obedient in whatever it is He's calling you to. Right? So whatever that amount is, doesn't matter. You give it, and you give it joyfully, and just let it go. Open hands, okay? Because if you have closed hands, closed fists, guess what? You can't receive. Open hands, so that way it comes and goes. You're just a steward. Remember, it's all His anyways. You're just a steward. You're just a manager. All right, and that's all kingdom principles. That's some of the stuff that we teach at FIRELife. So, $1,000 for giving. Mortgage, is $3,000. It's actually rent, okay? So they're renting. It's $3,000 even. Utilities is about $500, right? And that fluctuates, especially like right now, summertime, they're running their AC. Electric bills go up and down, but it's just around that. They were averaging about $487, but they're expecting that it is going to go up during summertime. And their living expenses. So this is everything else: groceries, gas, clothing, just all the basic stuff for them to live and survive off of. It's about $1,400. And then they have some debts. They have a few credit cards. Their payments are about $500. Okay. And then they have 2 cars. One's like $487, and one's like $520. So I rented it down to $1,000. So right now, 1,004, 5, 6 is about 7,400. And so what I've told them is they need to pay themselves first. Now they are putting a little bit of money into their 401ks. I said, but what are some of your long-term goals, right? So they do have 2,400 cash flow, but they are going to be saving, okay? And this savings, they actually have broken down into a couple of things, okay? They have some what we might call sinking funds, okay? There's a few things that they're saving for, future expenses that they know are coming up. So I said, okay, well, just round that out. That's $1,000, okay, that they're doing. So we're going to change this to a 1, okay? And that is their cash flow, right? Because they need to be thinking about what they're going to do when those expenses come up, okay? So that's how things break down. Now, what I told them was like, look, this $1,500 right here, $1,500. If you got rid of these debts, that's $2,900 of disposable income on top of the $1,000. That'd be $3,900. So, how fast can we get rid of these debts so that we can increase this number right here? That's the focus. I mean, what could you do with an extra $1,500? Now, depending on your household, that might be nothing. That might be nothing. That might be pennies. But for most people, right, if you're an average everyday American, $1,500 is some serious cheddar right there. Cha-ching. Okay. So, this family's conservative. They're sticking with the debt snowball plan. So, that's what we're focused on right now. So, they're going to be throwing this extra $1,500 right here towards the smallest debt. Okay. I didn't list out what their debts, what the actual balances are on these credit cards, but the way the debt snowball works is you list, right, your lowest, you list all your payments, right, and you pay them off lowest to highest. Okay? So you list out all of your debts, lowest to highest, okay? And you slowly start attacking the lowest debt. I think one of the lowest payments on this card right here, I think it was like $46. So as they pay off that balance, and they'll be able to knock it out with this money and put some of this money onto the next card, that's an extra $46 of cash flow that is now going to be added on the next month to the next card. Right? So that's how that works. So you list these out, lowest to highest, and you start attacking the lowest one first, then the next one, and you start doing all of that disposable income. Right? Now, this right here, okay, if they didn't have those other expenses that were coming up, and what we teach, right, is you should stop your 401k, you should stop everything and attack this debt. Now, they are choosing not to do that. That's their choice. But if you follow what the plan says, you follow Uncle Dave, he's going to tell you, stop all your giving, not your giving, stop all your contributions to your 401ks and any other accounts. These, unless it's something critical, like you have some annual taxes or something that are going to come due, or you have some expense that not something frivolous, like something that you actually are going to have to pay for. All of this, for most of this, should also be going towards paying down your debt. That's the debt snowball. Lowest to highest. You start with the lowest balance. You start paying that off, attacking it with gazelle intensity, as they would say. You pay that off, and then you take that extra income or extra payment that was going towards that card, and you start tacking that onto the next card. And it's slowly, right? You pay off the next debt, and you pay off the next debt, and the next thing you know, it just starts snowballing. Boom, 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 boom. And by the end, you're throwing big chunks. Okay? Let's say we start to get rid of this credit cards. That's an extra $500, so this becomes $1,900 that we're tacking onto that car debt. And these are kind of high. There's like one's like 26,000 and the other one's like 32. Look, I'm not a judge. I did the same thing. I even leased a vehicle. Thank God I just got rid of that sucker, but it ended up costing me a lot more. Because one thing they don't tell you, by the way, when you lease a car, just so you guys know, yeah, it's a little cheaper or whatever, but then at the end you got to pay an inspection fee. And if there's anything wrong with the car, any little ding or the tires are too bald or whatever it was, and they weren't bald, then trust me, I sat there and argued with them. Next thing you know, I got stinking $1,200 I got to fork out to pay for a lease. It just increased what I would have paid over the last 2 years on that car, right? Anyways, I digress. So that's the debt snowball, okay? And again, this method works with any situation. And if you follow what Uncle Dave teaches, and again, we've been following Uncle Dave for a long time, most people will pay off their debts, depending on kind of where you are, other than your mortgage, in less than 2 years. It's about average of 22 months, okay? It's a little slow going, things move a little slow, but you start making progress and you start having a little room to breathe, okay? Now, obviously, they had a good amount of cash flow here, right? They were starting out, $2,400, right? They're saving some money for some future expenses, some sinking funds. But either way, $1,400 was what they were starting out with. That's a good chunk that they could start doing at this debt, right? And look, you should be focused on trying to eliminate as much of your expenses as possible, or increasing your income, side hustles, right? So whatever you need to do, increase your income, decrease your spending in order for you to increase your cash flow, and you can start tackling this debt much faster, right? So we'll do that one, and decrease, right? Make these go down, or a combination of both. And that's how you get out of debt much faster. So we started at about 87,000 plus, and we paid off, in the first few months, in the first 8 months, we paid off over $67,000. So it works. It works if you work it. You have to be disciplined, because having a budget that's the worst star ever on the planet. Boom. Having a budget is key. If you do that, you can succeed in any other thing. You learn to have self-control and that self-discipline, you can do it. All right, so velocity banking. What is velocity banking? Some of you have heard of it. Some of you may not have heard of it. Again, check out videos about there. Denzel Rodriguez, good dude. He has a lot of videos about this stuff. There's several others out there that are teaching it. There's other names for it. But essentially, this is what you would do, okay? Let's say you can do it with a credit card, but typically you do it with like a line of credit. If you have a HELOC, you could also do it with that. Now, the way I first learned about this is for a mortgage, paying off your mortgage much faster. Okay, so let's just throw a number out there. Let's say you have a mortgage of, you know what, let's do a big number. Let's do an easy number. Okay, let's do 500,000. Okay, and let's say you get a HELOC for, 100,000. Right, so your house is worth a certain amount. Okay, so let's take this example. You have about $8,400 of expenses, okay? Or let's call it $2,400 or $7,400, right? Because you have the savings there. So let's just say $7,400, okay? So the idea would be that you use your HELOC, right? So you have a HELOC. For those of you that don't know what a HELOC is, it's a home equity line of credit, okay? So let's say you take out, so your bills are $7,400, you're making $10,000 of income. So $7,400 times 12 do the math. It's 88,800. Okay. So here's the idea. Okay. You take out the 88,000, okay, of your HELOC, and you apply that to your mortgage. Okay. Right out the gate, you're now looking at a 412 balance. Okay. Your payment's still the same because it's a principal reduction. Payment's still the same, and you're still going to be making that payment because it's part of your expenses, right? Now, how are you going to pay that back? Here's the idea. Every month when you get that income, it's going to go right back into the HELOC, okay? So 10,000, so right out the gate next month, right, comes in. So you're going to be at 78,000 balance, right? Because you just paid that off. You paid off an extra 10K, right? Now, throughout the month, you're going to be using the HELOC, the line of credit, to be paying all your expenses, okay? Now, if you're saving this money, this technically becomes cash flow too, right? Because you're going to leave it in the HELOC. You don't need it right now. Until you need it, you'll use it. But for right now, you're, what you would call chunking, right? And you do the velocity banking. So you do a chunk, boom, boom, take out the 88,000, drop it towards this. Think about that. Let's say your mortgage payment, okay, was the $3,000, right? The majority of that is interest. Okay, it's mostly interest. So if all of a sudden your balance is now 412, that interest becomes a lot less, and you're going to be putting more on the principal. That's just how it works, right? So you're going to be saving a ton of interest, and you're going to be taking down this amount even more every month. Boom, it just starts to get even higher. So the amount of interest you save is ridiculous. Okay, so next month, right, it goes up. Let's say the 7,400. All right, so 7,400, you're going to tack that on, right? So that's 85,400. Okay, and then now, so this is month one. Right now, this is going to be month two. You drop that other income, so now this is going to go to 75,400, right? Because you dropped that 10,000, and again, it could be a little higher depending on how your income is. So now, and again, this month you're going to go out, you're going to spend the 7,400. So month three, your balance is going to drop down. What is that? To 67. So 75,400 minus 7,400, 68,000. $68,000. So you see how this works, right? This is month three. It slowly starts to reduce that balance. Now, again, this starts to climb down even lower because every month that you're making that mortgage payment, your balance, more of the principal is getting paid off. So that's how this works. So you do this all the way throughout the rest of the year. Again, you know you're going to have these expenses, and the money stays in there, right? You're not paying. You're paying a lot less to the HELOC because remember, every time you drop your HELOC, your income in there, that counts as the payment towards the HELOC. So you don't have any extra payment on the HELOC because your income is making the payment, and you're going to be paying just a really, really small amount of interest. It's very, very negligible, right? But you have to know your numbers. You have to play this out. You have to really work this through. So next month, boom, 10,000. So this goes to 58. Or actually, sorry, you add the 7,400. So this goes to 70. Anyways, you understand what I'm saying. That's velocity banking, right? So I have spreadsheets that kind of go through the whole plan, and every situation is unique. Everyone has different numbers, right? I mean, we get down to the cents, okay? It's just the way I am. I'm a nerd. I'm a total geek. I use spreadsheets and got to make sure everything balances out. So we help our clients do this. We set up a plan. We talk through it. Look, not everyone has access to a HELOC. You could use a personal line of credit. Okay, personal line of credit works really well with this revolving credit. You could do it with a credit card as well. If that's all you have, there's ways to work it. I try to steer people away from that. Okay, because you're playing with fire there with the credit cards. Right? It's very easy. And if you're not disciplined enough, obviously you haven't been disciplined enough, or you wouldn't be in this situation with debt. So, discipline is the key, and budgeting is the key here. You have to keep your expenses low. If you can get these numbers down as much as possible, this becomes much easier. And look, this is a big scenario. Maybe you don't do this. Maybe you don't have access to 100K. Maybe you only have access to 20K, 25K, 30K of a personal loan line of credit. There's ways to work this, especially if you're just focused on doing it on the debt, which I credit Denzel Rodriguez for this. So thank you, Denzel, for showing me that, because I had only seen it work on the mortgage. I've only heard people talk about paying off your mortgage. I mean, you can see if you start to do this every year, within 6 years, 7 years, you pay off this mortgage. It's ridiculous. So your 30-year mortgage for $500,000, you pay it off in 7 years or less. It's amazing. But you can do it on a micro scale using a line of credit. Let's say you have a line of credit of 20K or something, right? Maybe it's 10K, right? Maybe it's 10K, whatever it is, and you have 10K coming in, so you paid off a bunch of debt, you chunk a bunch towards that, you pay the income off the line of credit, you slowly start depositing out what your expenses are, and you slowly start paying it down, just the way this works. So it works. Velocity banking is amazing. So we've already helped several clients like this. We're going to keep pushing this. We're going to keep educating people about it. So if you want information, you can reach out to me. Okay? FIRELifeFinancial@gmail.com. Our website is getting built out, so it'll be at FIRELife Financial soon enough. Angel at FIRELife Financial. But for right now, FIRELifeFinancial@gmail.com. Reach out to me, and we can talk about your numbers. But you have to know your numbers. You better come prepared. You have to know how much your income is exactly to the penny, as much as possible. You have to know what your expenses are. Again, you could estimate, right? Things go up with utilities and stuff like that. We get it. But for the most part, you should know your big numbers. Income, expenses, your debts, exactly how much you owe, and what the payments are, and your cash flow. It should be very easy. It's math. It's not hard. If you need help, we can help you. Now, let's talk about infinite banking. Okay? And this is the stuff that we're learning now, that we're starting to teach, right? And we're starting to implement for ourselves. What is infinite banking? It's a very unique concept. It only works with certain life insurance policies, dividend paying whole life insurance. It does not really work for others. IULs, I would not recommend, okay, because just the way that things work, your money's tied in the index and it doesn't grow as much. You just don't know. On top of the fact that the cost of insurance keeps going up every year with the term. Like, there's potential for big returns, right? If you're putting enough in your cash value, but it's risky. Okay, I would not really recommend it for velocity banking. You have to use dividend paying whole life insurance, and it has to be structured right. If you don't structure it right, it's not going to work, because if the way most whole life insurance policies are structured, a lot of the cost, initial upfront cost, goes to the cost of insurance, and if it's not structured right, you're going to be paying that for a while, right? And some policies, especially the older policies, you don't break even till you're 20. It's ridiculous, and that's why these policies get a lot of heat from Uncle Dave and other people, because they weren't structured correctly. But if you work with someone that knows how to structure these policies the right way, then it becomes much more lucrative, and you can break even year 2, 3, 4, 5, maybe 7 at most. So it's definitely something to consider. So again, for infinite banking, you want to use dividend whole life. Okay, and the way you structure these is so that you have minimal, okay, cost of insurance, okay, what we call premium, and maximum cash value. Okay. Now, also you have to be careful because you have to also worry about your MEC, a modified endowment contract. That's basically the government, the IRS, because Uncle Sam wants his money. So they don't want you to use this as an investment. They want you to use it as a savings, as a life insurance. So, or I should say as life insurance with the savings element. So they limit the amount that you're able to put in. So if your premium, let's just call it, let's do an easy one. Let's say it's a 75-25 split. So let's say your premium is $2,500. Okay. $2,500 in your premium and insurance premium. Let's say that's your cost of insurance. Your MEC limit might be, depending on the company that you work with. Not every company does this way. Everyone has different things. So we're doing a 25-75 split here. Your MEC limit might be $25,000. Okay. So you can max fund your policy and build up cash value up to $25,000, but this is the cost of insurance, the $2,500. Okay. So and these are annual, right? So you can max fund it. Let's say you have, you're putting in $25,000 at most, right? 25,000 of that is going to go. Actually, sorry, I messed up here. So I was thinking of 1090 split, but so let's say this is 10,000. Sorry, 10,000. So you can be funding that, and then at the end of the year, you might have about right. You'd have the 7,500 in cash value. You put in 10,000, right? So, and that could be your MEC limit. That's the most that you can put in per year. So after 2, 3, 4, 5 years, you might have, let's call that, let's say at year 5 you have, let's say $49,000 or something, and then year 6 you're at 50 or 62,000 or something, right? Because you're getting paid dividends, you're getting paid interest. You usually have a floor of like 4%. You can go up a little there. Some insurance companies, depending on different insurance companies, Guardian might pay you. I think they average. They give you these numbers so you can check it out. They've actually paid out. I think they're at 5.85%. Someone like a Mass Mutual might be at 6 point something percent. Others might be down in the 4s or low 5s. So you have to work with the right kind of company. It has to be structured the right way. So this is infinite banking. You start to build up, right? So let's say this is $62,000 after 5 years. You can then take a loan, a policy loan against that, and let's say your death benefit was, I don't know, let's say $500,000 when you started. But every year as you start to max fund it, you're using PUAs, paid up additional riders, right? So paid up additions, your death benefit starts to climb a little bit. Maybe, by this year you're at like, 585 or something like that. You can take a policy loan up to your cash value, okay? But that loan is not on your cash value. That loan, the insurance company uses your death benefit as the collateral. So you take a policy loan, let's say for $50,000. Now you're going to pay back interest on that to the insurance company. That's how they make their money. But they're going to use the money out of your death benefit. But here's the beauty of it. You don't have to pay that back if you don't want to. Or if you do pay it back, which we teach people how to do this, and that's how you become your own bank. You pay it back and you pay yourself with a little bit of interest. So you're now earning the interest the way you would normally pay a bank or a credit company interest. So, but you take that money out, $50,000, right? You can use this to fund a car, college, maybe a property, right? An investment property of some type. It starts earning you money. But let's say you just want to use it for buying a car, because you buy a car every year, right? These people got 2 cars. So let's say that 30,000 or something, right, that they used. Well, those 2 cars that are right now are like 50-something thousand. In balance, you pay that off, right? And for the next 5 years, you start paying back that loan with a little bit more interest. So let's say the insurance company charges you anywhere from 4 to 8% interest. Let's say you round it up to 10. So you make an extra, let's say it's 5, let's just throw a number out. Let's say it's 5% interest. You're paying it back at 10% interest. You made 5% interest on your own loan. You borrowed the money from yourself and you paid yourself interest. Now you're making money. And now this continues to grow. So as you keep funding the $10,000 a year, boom, 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 this continues to grow, right? Because you didn't take this money out of your cash value. You borrowed, the insurance company cut you a check for 50 and they used it. They choose your death benefit as the collateral. So every year, right, whatever the dividend is that's paying, interest is being added on, plus you throw your extra 5% that you're throwing on here, right? Because let's say they charged you 5, and then you have another 5. So that 5% on this 50K is what keeps going back and adding into your cash value. Let's say after 5 years, you paid off those cars, you paid off this debt, you continue funding your 10,000 in there, boom, 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 it just starts growing. Let's say after 10 years, right, you've put in 100,000, but because of the dividends and the interest you paid on some loans you put back, you might have 120K, you might have 150K, depending on what it is. So after 10 years, you'd have 150K, you only put 100, right? And now you can use this 100 grand because you've paid off this loan, right? Go buy a bigger property. Go buy, again, fund another car, fund college, put in some investments, buy some gold, whatever. It's your money. You're now your own bank. Let's say your mom needs to borrow some money. All right, Mom, I'm going to let you borrow some money. You're going to pay a little interest on it, but guess what? You can pay me back when you want. Now, let's say, for whatever reason, this 50,000, you decide, you know what, I'm not going to pay it back for 10 years. Your policy, if you keep funding your policy, it's still going to grow, but you'll only be able to borrow 100, right? Because you have this 50K outstanding, right? So now you're only able to borrow 100,000. Oh, sorry. But that's still 100,000 that you're borrowing off yourself. And eventually, you pay this back with some interest because you want to pay yourself back. Okay? You want to pay yourself back, and you got to pay the insurance company back. But let's say you die. Okay? God forbid. Let's say you die and you still owe this 50K. Remember, it was borrowed against the death benefit. So your family, instead of getting 588, they're going to get 538 minus whatever interest or whatever. So yeah, they get a little bit less. Right? But you use this money when you needed it and it's all there. That is infinite banking. Now, this is very rough numbers. I'm going to get really into this later. I'm going to show you some real world scenarios. Some of the stuff I'll probably show you how we're planning it, how we're funding it. And I'm going to be learning a few more things. I want to really dig into how you can use and fund your bank, your policy with your line of credit or with your HELOC. Now, most people will teach you don't pull this money out of your house to fund this policy. So there's risk involved. You have to be disciplined. Not every situation is going to call for this. Not everyone should be doing stuff like this, right? Depending on the numbers, depending on your cash flow, that's probably going to dictate whether you should or shouldn't do that. But you could potentially use this line of credit, right? Let's say you use this line of credit to max fund your policy, right away build cash value. You take the loan out of the cash value to pay back the HELOC or the line of credit, and then you continue doing the velocity banking to pay back this, and that loan is outstanding, but it keeps growing. You max funded it, and it starts earning interest on you, dividends. It's a beautiful thing. Beautiful thing. All right, well, hope you learned something. It's a lot of information. Debt snowball, budgeting, velocity banking, infinite banking. If you need help, when you get to that point, that I've had a moment, and you decide that you need help, reach out. We give you no obligation, free consultations. Just talk through things. And if you want to work with us, you want to become my client, we can help you. We'll structure a payment that'll work for you. Especially if you're a single mom, That's how we give back as well. So I call it like a ministry. So if you're a single mom out there, you need some help, reach out. This is a phone call's free. Just what can you do? Right? Send me an email, firelifefinancial@gmail.com. I'm Coach Angel. I appreciate you. I love you out there. Thrive in the vibe. Learn to thrive through all the vibrations and craziness of life, this crisis and everything else that's going on. There's a way out. Get your finances in order. Take control of your finances. And let's see what the future can hold for you. So I appreciate you. Thank you very much for listening. Subscribe to this channel. Like this video. Share it with somebody. Talk to your spouse. See if this is something that you might want to look into. At the very least, get out of debt. Using the Debt Snowball is the easiest way. It takes you a little longer, but it's simple. It's fast in a sense. It'll help you get out of debt. So you can do it. I believe in you. Take care. Bye.